Hi, and welcome. I'm so excited to introduce you today to this amazing man with phenomenal tax strategy. Are you somebody who's not selling a property because you've got capital gains, or maybe you're trying to buy a property from someone, but they're afraid of the capital gains tax? Well, Michael McIntyre has a solution for you. He's helping out a client of mine who happens to have $2.2 million of capital gain that he's rolled over through multiple tax deferred exchanges. And I found Michael and he's helping my client. And I'm so excited to bring him and his strategy to you. So welcome, Michael McIntyre. We're super excited to hear from you and about your solution for this.
Thank you, Holly. Honored to talk to you and honored to talk to your clients and prospects across. You are an amazing real estate professional, diamond out there, and everybody should listen to Holly. She gets things done.
Well, thank you. Yes. And quick background on me, if you've never heard anything about me, those of you who are watching, I used to be a CPA and I have an MBA in finance. So I am very numbers driven, numbers motivated, always looking at the financial impact of every real estate transaction and how to minimize taxes for my clients. Not a practicing CPA anymore, but I speak the language and know how to direct people those ways. And that's why I'm really excited about this strategy. So Michael, why don't you take over and give us the overview of what you can do to help people?
Yeah, thank you, Holly. Yes, I'm not a reformed CPA yet. I'm counting, I've got the accounting background, and our company called Estate Planning Team has been around for nearly 30 years to try to interrupt what I call the tax continuum. And if you don't interrupt the tax continuum, you may be held hostage, whatever you want to call it, by taxes. Because if you think through taxes as Holly does, that's how she thinks. And that's why she's successful. And many people are successful because they think about the biggest expense of your life at a certain point, at a certain wealth, is going to be taxes. Think about it. You either have self-employment tax, payroll tax, and then you have another tax, which is your income tax or a capital gains tax. Third, you're going to have everything you purchase has a sales tax on it. Third, fourth, you have a property tax that's forever on either a car or a boat or a house. And then if you're somehow through all of that gauntlet, you're successful in life, you're going to have a state tax, death tax, whatever you want to call it. So if you don't hack one of those models or some of them, you're going to be incarcerated, whatever way you want to call it, in the prison of taxation. And this is a big, big problem. It is, we fought a revolution over 2%, and now we're easy 40% plus on it, just on the income taxes. So you've got to take some really good strategies in order for you to avoid or mitigate. You're not going to avoid it, but to mitigate the tax continuum that you have in your life. And that continuum was all of those phases that you have. Now, there are laws, and these laws you can work to your advantage. And this is what we do at our company called Estate Planning Team. And like I said, we've been around for 30 years, and we like to think that we're one of the best secrets. Well, one idea is, let's say you can't get, as Holly was saying, let's say you can't get a property to be purchased, that beautiful property on the beach, the beautiful property wherever you want it, but you can't get that seller motivated because they're incarcerated in the tax, in the tax world. Now that could be because they did a 1031 previously, they owned it for a long time. And so that capital gains tax, the only solution that most people know about is a 1031. Now that won't work if they live in it, so they can't do a 1031 there. And if they're tired of tenants, toilets, and trash, and they want to move on to cruises, clubs, and cocktails, that isn't going to work either. So our structure is designed as an alternative to a 1031. Maybe you're in this position. Maybe you're the one that has to be forced to pay the capital gains taxes. So what we do is we defer what's called the constructive receipt. When you do a 1031, the 1031 itself is you're selling the asset and then you're having another property, but you do not receive the funds. And by receiving the funds, you tell the IRS, Franchise Tax Board, or wherever you're located, gee, I need to pay taxes on this. So when you switch it from one property to the other property on a 1031, you're avoiding the constructive receipt. Well, there's another structure. There's another way to do it too, an alternative to go from tenants, toilets, and trash into tenants, toilets, and trash, which is our structure called the deferred sales trust. The deferred sales trust allows you to sell the property and you sell it to a trust that you name. So you create this trust and it issues you a promissory note, an IOU, a seller carryback financing, but it's going to be not with the collateral of the property. So you don't have to foreclose on it. It's going to be on cash or investments that you're going to make. You're going to sell it to the trust. The trust is going to issue a promissory note. That promissory note is going to be your terms. You're the lender. So you're creating your own loan from the trust. The trust creates this loan back to you. It buys it just before the sale of the transaction, issues the promissory note, and you go invest it into most people do is financial assets, but some people years later, months later, they want to buy another property or another business, they can do that. So this structure works for real estate, works for a business, works for artwork. We've done artwork and collectibles, which can no longer do a 1031. And so it's a useful tool to know, to have for both being a seller and maybe even as a buyer.
So let me ask quickly, can you use it for a primary residence also? I think you can, right?
Yes, you can. Now the primary residence where you've lived in it 2 out of the 5, you cannot do a 1031 on that. That's correct. But if you are downsizing, we have a lot of people that, as the Steve Martin joke goes, I have $10 million of real estate and $2 of cold cash, or however that stand-up routine goes. Maybe you're real estate rich, but you're cash poor. And the house has got some deferred maintenance, but you can't do it. And Holly's going to get you to sale on that property. But you're afraid of the taxes. Well, IRS has the 121 exclusion, which is $250,000 per person. And as a couple, you get $500,000. So let's say your cost basis, you paid, with improvements, maybe $1 million, but now it's worth, let's say, $3 or $4 million. But you want to be in a smaller place, maybe move out of state, whatever. You're going to downsize. We can actually strip out. It's possible to strip out your cost basis, which is essentially $1 million what you paid for it, and then the $500,000 that you have in the 121 exclusion. So now you could strip out, before the sale, you could strip out that $1.5 million out and put all of it into the deferred sales trust. So your old home, let's say we could get you 5-6% on that money. That old home is paying for your new home, and you have a paid for, hopefully, $1.5 million home that is paid for, and your old home is paying for it. So new life, and maybe it's a newer construction and less of a headache and a bunch of other things too. So yes, that'll work.
Well, and another problem that I see a lot of people have as they age is they're in a 2-story home and they don't want to have 2 stories anymore. I mean, I've heard stories of, elderly people sliding up and down the stairs on their behind because they're afraid to walk up and down for fear of falling.
Yeah.
So, and one of my clients I was talking to last week, he's selling his parents' home who have passed away, but they paid $30,000 for this house. It was in the greater LA area, and it's now selling for 1.7. Now the parents have passed away, they don't need it anymore. But if someone really held a house that long, that's a lot of capital gain they'd be on the hook for.
It would be.
If they didn't have a strategy like this. Well, their strategy sadly was to pass away, and it was a 1-story so they could live in it forever. But yeah, so Yeah, if you're watching and you have parents in a two-story house and they just don't want to sell because of the huge capital gain, you should definitely check out this strategy.
Yeah, and it's going to be a problem for all of us at some point, where we don't want to tackle, obstacles such as that. And I'd hate to think of, my parents have passed away, but thinking about my parents being stuck on the first floor or something like that, and your home, and it all falls under that whole umbrella of your home owning you instead of you
Mhm.
owning the home. And when that happens, people don't understand some of the laws because they're complicated, and they're designed to be complicated. Because
Right.
if you know those things, then you pay your it's somewhat designed cynically to be shackled to taxes. You do the
Yeah.
easiest thing, and that necessarily, just like health, it's not your financial health, works the same way as your physical health of trying to stay healthy. It's easy to sit home and eat bonbons and whatever, but it's harder to go exercise and do things. These are exercises that we try to implore for clients, so that they're not having such a burden on taxation.
Yeah, I love it. Do you have a couple of example slides that you want to share? Love to see
Sure.
some of those, give
Let me
people an overview.
let me see what I can do here. Pull this up and pull up a slide, but I'll talk about some different examples here. Is that we have clients all the time. We've done almost $8 billion in transactions over the years. And so sometimes I think that I've seen it all, but then I get a new one each day. But I was thinking about a client today who sold their business, for roughly 30 million, 37 million, and
Wow.
here in California, and we were able to defer all the tax
Right.
on the transaction, and he's able to secure his life. And he's got one son, and that's secure, and we got a substantial amount out of the estate itself, so that he doesn't have to really worry about, and he's got a legacy for his kids itself. And let me share my screen here. And I'll just try to walk through an example if I can.
Yeah, that would be great for people to see how it works.
Remembering the name is the Deferred Sales Trust. You can Google it out there. We've been around for a long time.
And
We
let me interject really quick. A lot of people in the real estate world use DST to refer to Delaware Statutory Trust. Is that right?
That's
So
correct.
don't confuse it with that. It's completely different. So if you hear DST, 90+% of the time, people are going to be talking about that other type of investment, which is basically just an investment. It's not a tax strategy.
You're right. That is a common thing that we hear with real estate professionals when we go down the road of getting to the acronym. We love acronyms in this business. Nothing wrong with it. Probably separates us from a lot of other languages that can't use acronyms. So we love acronyms, but they can also be very confusing. And it is simply a Delaware statutory trust is simply a 1031 by another name, a syndicated deal itself, a sponsored syndicated deal.
Yeah, it's just an investment asset. That's all it is. So very
So if
different
you
than
could
this.
think of yourself here in the left-hand corner as an individual, you're coming to a position where you've got an asset that is highly appreciated, could be a business, could be more commonly real estate, could be a collectible, any number of things where you've got some capital gains to worry about. Most businesses that we work with sellers have very little, if any, capital gains in it. And some of them you may have had depreciation recapture to deal with, which will up your taxes, and a host of other things that we could talk about. If your situation requires it, we'll go through, and you want to have an evaluation, we'll do an evaluation and talk about your situation personally and privately. So you have this asset, you want Holly to sell it, and you're scratching your head about a 1031 or anything else. And we have 8 attorneys within our realm that are transactional and tax attorneys that understand this. And we have worked with them for years. And then we have a number of trustees. And so this is our system that we have, and our attorney gets an engagement agreement with you. And we only charge you when you're funded on the transaction. So there's no fee, there's retainer. And just want to make sure and understand that if you were to sell this, people say, well, do I elevate my level of a risk for the Franchise Tax Board or the IRS? And I say, probably the opposite. If you're somebody and you're making $300,000-400,000 and you're going to have a $4 or $5 million gain, and you're not going to use our structure, I promise you, and Holly, as a former CPA, if you go from 200,000 to 4.2 million by not doing it, are you at a higher level of risk?
I think they might want to put you under a microscope and see what other opportunities they can find to take some of your money.
Yeah, exactly. So our structure is designed with Form 6252 worksheet where we carry the whole balance on there. We say to the IRS, hey, it's right here. It's right here. And so what we do is that you as a seller, you're going to convey your interest in your property, whether you own it in an LLC or under a contract. Contract assignments allowed in California to assign a contract. You can quick claim it to the trust that you want to name prior to the sale. So the trust owns it for a New York minute, if you will. And then the buyer pays your trust and not you, avoiding the constructive receipt. Now you've got the funds in this trust, either by your financial advisor, or we do this as well. We have a wealth management company, and the wealth management company, we hold the funds at Schwab with us, and you can see your account, see your money right there. And then you've got this big reservoir of money, and you've now said how you want that money back prior to the sale. And you could change this too. So you have that money, and instead of paying the highest tax, because we have progressive taxes, the more money you make, the higher percentage you pay, the more money you pay, the more money that you're declaring. But if it's in this reservoir, you're sending it out, the cash flow that maybe you need to live on. And my philosophy, first principles on investing, only take money that you're going to spend, or that you need to tell the bank that you have so you can qualify for a loan. Those are the 2 reasons that you need to have income. Other than that, you do not need to put it through the meat grinder of taxation, and that's called tax engineering. The rest of it, we can defer, we can do other things, and you can build it up, because guess what? Things are going to be more expensive in the future. And so now you've got this money reservoir of funds, and you're having it send out to you, and we can tax engineer this money back to you at a much more favorable rate. Even though taxes could go up in the future, your taxes don't have to go up, because we can engineer it to accompany what your lifestyle, your borrowing needs, or whatever your needs are. We can engineer that, and more likely than not, we will lower your taxes by that measure. So you have this structure that you're going to be able to invest and have to provide as a legacy. You pass away, you and your wife, or you and your spouse, you pass away, and you can leave this income and cash flow to your children, versus giving it and going behind the barn and shooting your money. You're going to have this legacy that is going to perform. And what we have found, Holly, over the years, is that on average, if a person who has a fairly low cost basis structure sells and pays the tax and tries to live off of that income to try to get a 7-8% rate of return, versus doing this on the deferred sales structure, your money maybe last, without doing it, maybe last 12 or 13 years before it all goes away because of inflation, taxation, and all of those measures. Those are your big enemies there, versus 2 to 3 generations in the deferred sales trust. So
Wow.
you might say, well, what good is it by me deferring a tax? Well, because you're having the life arbitrage on it. The life arbitrage means that the money you would have lost on per million in California, Are we ready for this? It's 37.1. So if your cost basis was 0 and you had $1 million gain, you will pay $371,000 per million to the state and federal governments. So that
Michael,
371 is going to be earning money for you. If you can do that, if you can pull that off, that life arbitrage means that it earns, tremendous benefits and blessings for you and your family and your heirs.
and doesn't it grow tax-free?
So it grows.
It grows without getting taxed.
Yeah.
When you take it out, you pay the tax, right?
Yes. As soon as you take it out, you pay the tax, just kind of like an IRA.
Yes, I love that, because if you're starting with a bigger nest egg, it's gonna grow on that balance instead of whacking it way down and then growing it. Just,
yes,
I love that opportunity.
For people who are younger or people who don't need the income, there could be a compounding effect too.
Yeah. So how does this work? Say somebody has a 1031 exchange and going, and they're not able to appropriately and timely identify replacement properties, which I've heard of that happening twice in the last year with people I've talked to. Does this strategy work for them as well?
It can, but we have to have the right QI, qualified intermediary. If the qualified intermediary does not want to cooperate, it becomes difficult, and sometimes we can't do it. Now, the bigger the QI, unfortunately, my sad experience is, what do we say? What do we know? The bigger, the less cooperative they typically are. Okay?
Yeah.
But if they're in that 40, as you suggested, if they're in that 45-day identification period and they haven't identified because the grass isn't greener, we can set up a trust in that 45-day period, and on the 46th day of failure of not completing it, the QI, if cooperative, will send the funds to the seller's new trust and avoid the constructive receipt, and then we have the terms and conditions just the way we are now. Now, also, if you did identify, but it isn't going to close and you're past the 45-day period, we have to wait 181 days for it to go into the trust. So it's cooperation and then timing, identification, and so on and so forth. But we have a short list in the future of QIs that will work with us in California, outside of California. There's also the concern that the 3 1/3 withholding could come into being also with California under an 8-year clawback says that they're going to withhold 3 1/3 on a transaction. So that's something we'll also work with the seller to mitigate that as well.
Fantastic. One last question. Has this strategy ever been audited by the IRS before, and what has happened?
Yes. So I think between the state and the federal, I think the number is we've had inquiries at least 60 times that I'm aware of. And 13-ish audits with no trigger, no change. Our attorney, our counsel, when they represent you in the contractual arrangement, the engagement agreement, agrees that if you complete the transaction, remember, you don't pay for anything until it's fully funded. But when it's fully funded, our counsel represents you in the very unlikely event of an audit. I mean, 13 audits into 8,000 is not a, is not a
tiny,
not a big number. Okay, not a big percentage.
Right.
And so if they are, our counsel will represent you in that very unlikely event. Now, a bunch of times, as you know, being a CPA, the mere fact that you've got your stuff together and you respond to the IRS in a timely manner, they go away. So the great majority of cases, historically 13 is the number, but it starts out with a bigger number of just inquiries that we will, and we want to defend the structure. And also there's only a 3-year window on standing with IRS has from the time that you show that 6252 before they would have penalties and fees on you. So a lot of people, get worked up over the fact that, well, gee, this will bring me into a higher level audit? No. I think we soundly defeated that, hopefully. And then the second thing is, if I do get audited, what's going to happen? Well, you have a counsel, an attorney counsel that is armed and ready to go on that.
Fantastic. Helps you sleep at night. So I know we're coming to the end of our time here. Did you have anything else that you wanted to share that you thought was important about it?
Just, real quickly, here's a $10 million transaction, Holly, that we did a few years ago.
I
The
love
client
it.
had a $8 million gain. And just to pencil it out, it's 1.6 million of federal taxes. The state of California is 13.3 presently on capital gains, 14.4 on ordinary income now in 2025. Ouch. It's the highest, it's Taxifornia, right? It's the highest in the nation. Then there's the net investment income tax, which is 304,000. So this client was dealing with 2.9 million in basically in tax. So the amount left for investment was 7 million. And by the way, you paid almost 3 million in tax, and you also raised your level of audit too by doing that. Okay? I think we've established that. So now you got 7 million. If you get if you're an investment professional or you get 6% on it, that's 12.7 million that you have. With us, we're going to charge you a $125,000 legal fee for doing this that is charged. So that means that your balance is 9.8 million. If I make you 6%, if your advisor, your financial advisor makes you 6%, you have 17,966,000. That means 5.1 million more in a difference. That should be pretty significant. We can change, the benefits are that you can change your payment options if you need to, ongoing tax deferral, 1031 alternative. We can sever out partnerships and interests. If you've ever been on either side, one of the worst divorces is severing partnership interest out of things. Well, we can, if you want to sell and you don't want to be punished, we can do that. We can help you out. Here's all the types of assets that you can do here that we talked about. And you can go back into real estate like we talked about. Here are our fees schedule right here, real quickly. And you can stop the tape at any time that you want to look at those fees. And then if you need to contact me, I'm here in Southern California. Holly and I are just in the same little town here, 949. Here's my contact information. I appreciate your interest in the deferred sales trust and us, and work with Holly. She's the best.
Oh, you're so kind. One more thing, which I don't think we covered. What is the minimum capital gain that it makes sense to look at this strategy? Did you say it's about 500,000?
I'd say so. I mean, if you're really aggressive and you hate, paying the taxes, maybe that's a bit lower. If you've got recapture, maybe that's a little lower, but it's in that ballpark.
Yeah. So if you're looking at 500,000 gain or more, definitely check this out. I myself am looking at it for a highly appreciated asset that my husband and I are selling this year, and we're super excited about it and engaging Michael and his team to move forward with a plan for us. So, if I'm doing it, it's worth checking out. Thanks so much for watching, and contact Michael. All of his contact info is also below in the description here, and we're both excited to help you however we can.
Take care. Bye now.
Okay. Sorry that went long.
Okay.
Thank you. Appreciate
Take care.
you.
Bye-bye.
Okay, bye.